Hey everyone, welcome back to the channel. I'm Zach Gordon, your personal and business funding consultant and credit transformation expert. Today, I want to talk about a business credit scoring model that doesn't get as much as attention, but is key if you're looking to secure business funding, the FICO SBSS. Now, you might be familiar with other scoring models like Experian Business, Equifax, and the Dun& Bradstreet Paydex score, but FICO SBSS is a one that a lot of people overlook, and it's huge for business cash lending. The FICO SBSS score is used by banks, credit unions, fintech companies, and commercial lenders, and even the SBA. In fact, it's a preferred score when you're applying for certain types of business loans, and understanding it can be really put you ahead of the game. Just like a personal FICO scores are the standard for consumer lending, the FICO SBSS has become a standard in business lending. So how does the scoring model work? Well, the FICO SBS score ranges from 0 to 300, with 160 being the minimum you'll want to aim for if you're serious about qualifying for business loans. Anything below 160 and your chances of approval start dropping quickly. But getting a score of 160 and above isn't just about the number. The score pool in several factors that make it unique. One thing you'll want to know about the FICO SBSS scoring model is a bit flexible, and that could be good or bad depending on the lender decides how much to weigh certain factors based on what they find to be most important. Here are some things that might get weighted: the credit scores of each owner, up to 5 people, your bank rating, industry, web presence, gross margins, and even DTI, debt to income ratios. They can also consider business credit scores from Experian, Equifax, and D&B. In short, they're able to look at a range of elements to gauge the health of your business. Now, here's what I don't love about this model. It's almost entirely in the hands of the lenders. Since they get to choose what factors to weigh more heavily, this means you might end up with a different score at one bank versus another. And that lack of consistency can be frustrating because there's no way to know exactly where you stand without actually applying. Plus, unlike FICO scores, you can't just check or purchase your FICO SBSS score. You might have a high score at one institution and a lower one at another. There's not much you can do about it. So let's get into the breakdown of how these factors play into your score. Here's the percentage breakdown. 35% comes from personal credit of each business owner with at least 20% or above ownership. 30% is based on business financials, things like bank ratings, debt ratios, tax information, and average receivables. 20% is determined by business-specific factors, industry type, time in business, your web presence, and business ratios. The final 15% considers your business credit reports from Experian, Equifax, and D&B. This means 50 of your score comes from areas of you have direct control, personal and business credit profiles. So if you want to improve your FICO SBSS score, focus on 2 key areas. First, work on your personal credit score since it accounts for 35%, making sure it's strong can make a huge difference. And second, maximize your business credit scores from Experian, Equifax, and Dun & Bradstreet, which contribute another 15% altogether. By keeping these scores as high as possible, you're already controlling half of your FICO SBSS score. Unfortunately, you can't directly check your FICO SBSS score, but you can do a thorough audit of your business credit profile. I'm offering a free business audit link below where you can review your Experian, Equifax, and D&B credit scores. We'll go over each factor to make sure you're lined up for the best chance of securing funding. If you're interested, hit the link in the description below. If you found this video helpful, make sure to hit the like button, subscribe, and click the notification bell. This way, you'll never miss out on any new content that can make a real difference in your business and getting any funding that you might need to get for your business.